and then the inventory side. And we're gonna go into each of these a little bit more detail. On the receivable side, these are what we would call seller-centric programs, where you as you're holding a receivable from your client, and you go to a financial institution and you ask whether that receivable can be discounted. And that, of course, is based on the how long the tenor is of that particular receivable and the creditworthiness of the obligor. So the way the banks look at this is on two bases. Either they will batch them, they'll take a look at your entire portfolio of receivables, and then probably, and if they agree to discount the entire portfolio, then they're going to probably ask you to get an insurance policy around that portfolio, either with you assigning the claim to them, or that you would be they would be the loss payee. When we talk about cherry picking, it means that the bank will take a look at your portfolio and then take specific receivables out of it and discount them. We call that cherry picking, obviously, because they're picking the ones that they have a credit relationship with or that are stronger credits. So that's how a seller-centric program would work. You can go ahead. So we did already talk about the buyer-centric program. This is where you, as a supplier, have an agreement with the bank to discount those receivables if you want to, once the invoice and purchase order have been matched. These are difficult programs for the banks to set up because they're administratively very heavy. There's agreements that have to be signed by both the buyer and the seller, and there is a lot of administration. But the banks like these programs because as in the banks call, they're sticky. Once you get it up and running, it's kind of hard to unhook the pipes. There are some aspects that are coming under scrutiny. We had talked about it before about buyers stretching out their sellers to unreasonable lengths or forcing them to get into programs, that kind of thing. The concept of financial bullying by buyers. So I think the market's becoming very sensitive to that. There were also some bad actors, mostly in North America and Europe, who were using these programs to hide debt that was not easily visible by investors or by the accountants. And there's been some pretty bad bankruptcies that have shown this to happen. So they're both the accounting regulators and the compliance regulators are actually taking a closer look at some of these programs. Thank you.
The one thing I might add on this one, Craig, if you agree with me, is that if we look at it from the supplier's perspective, we talked about financial literacy and the sorts of things a supplier can do to make themselves more financeable or bankable. One of the pain points in these payables finance, accounts payable SCF, and whatever else you call them, these things have multiple names, but this type of program, one of the things a supplier could do is try to mitigate the KYC, know your client, or due diligence process that banks have to undertake to onboard them onto these programs. So the extent that a supplier can be transparent, provide the data that the bank needs to make them viable as a member of the program, taking away that pain point makes it much easier to extend an invitation for that supplier to participate. Because one of the things to note about these programs is typically they're not open to the full supplier community. They might be open to the suppliers that maybe represent 20% of the spend, or sorry, 80%, no, the larger percentage of the spend anyway, 20% of the suppliers, 80% of the spend. That's what I was getting at. Or they might be the strategic suppliers, but generally it's not everybody. So there's a subset of that supplier community that gets invited onto this program. So to the extent that you can make yourself an attractive candidate for that, it might be helpful. Craig, does that make sense to you? Is that a thing you
absolutely.
agree with? Yeah,
yep,
so
that's a great ad. Thanks.
Highlight that a little bit.
So the third leg of the stool is the least used element of supply chain finance. It's becoming more popular because this concept of just-in-time inventory management, which has been around for a while, but it creates an issue where a company knows it needs $20 million worth of a particular product to be entered into its assembly line on a regular basis, but they don't need it all right away. So, but they need to know it's there. And so with an inventory finance, inventory-based supply chain finance is where an inventory company actually will buy the excess inventory from the client on a true sale basis, i.e. that inventory company owns it, okay? And they sell that inventory back to the client as they need it, obviously with a markup. But it frees up a lot of cash for the client. And frankly, if it's done appropriately, that if they don't want that inventory, then the inventory manager is going to have to eat it. So there has to be a high degree of trust between the inventory manager and their clients. The key here is what we call true sale, so that if you're holding $20 million worth of inventory and you're selling it to an inventory manager, that it has to be treated from an accounting basis as a true sale, not that they have a put back to you for any reason. If there is a put back to you, then your accountants will not allow it to be considered to be a true sale. So that's inventory.
Yeah, and on that one, maybe I could just bring in one comment that's COVID related, and I'm conscious of time here. I know we have to move it along a little bit, but just in terms of what's happening with COVID now, as people are looking at reconfiguration of supply chains and looking at how people manage their inventory, I heard, and I'm quoting somebody very well placed in the fintech and kind of policy space, saying effectively that in medical supplies and in agri-food, just-in-time inventory is verging on the criminal now, because we're seeing the implications of that and not having access to the right levels of inventory for urgent situations when we need it. So I suspect that there will be a little bit of rethinking from a policy perspective about how some of these supply chains and some of these inventories are managed in what might be considered strategic areas.
This concept of supply chain as a strategy, and it doesn't matter if you're an MNC or a small or medium business. You need to manage your supply chain not as a cash management tactic, but as a strategy. So one of the events that changed the world this was the 2011 earthquake and tsunami in Japan, when people found that their supply chains were thin, overdependence on limited suppliers, long lead time, lack of backup plan, lack of crisis response plans. And so what you started to see at that time were, within multinationals, the teams of people going out from both treasury and procurement to check the financial health of their key suppliers, not only but their ability to perform. If you have a $250,000 earth mover that's sitting on an assembly line because you're missing some kind of computer chip, someone's going to lose their job. So you need to make sure that your supply chain on both the financial side and on the procurement side is healthy. Okay. You want to take that one?
Yes, thank you, Craig. So just in terms of the supply chain finance and some of the trends we wanted to point out to you as SME owners and managers, one of the realities in international trade is that we have shifted away, in particular, I'm going to say over the last 10 to 15 years, from so-called traditional trade finance mechanisms. So any of you who've dealt in letters of credit and all the paper flows that are involved in that, you'll know how painful that can be, even though it's proven effective over many hundreds of years, and really done right, it really does meet the requirements of trade quite well. But what we've seen is a global trend. I was going to say near global, but I think at this point we can say global trend, shifting away from these traditional mechanisms to trade on open account terms, where the buyer and seller contract together to agree payment at a certain point in the transit of the goods to their final point of destination. So it could be on delivery, it could be somewhere at a transit point in between. So I mean, it's that thought of, listen, we don't need all of the complexity of these traditional mechanisms. We just need to agree shipment. We need to agree to a trigger or a point in the process where payment will be effected. And what that has resulted in was the creation of these supply chain techniques to address this open account trade structure or approach. And that's the 8 or 9 techniques that are reflected in the document we spoke about a few minutes ago. I want to point out that there's a great deal of attention being paid these days to sustainable sourcing and sustainable supply chains. So everything from environmental impacts, climate impacts, societal impacts, inclusivity, international development. So all of that sort of, and even good governance, the whole ESG, which is the latest iteration of corporate social responsibility. So all of that touched with a kind of a sustainability lens. We know today from multiple years of analysis by the Asian Development Bank and the International Chamber of Commerce that there is approximately $1.5 trillion per year, US dollars per year, of unmet demand for trade financing alone. The financing gap for small and medium-sized enterprises, and I think my recollection is reasonable here, is something in the range of $4.2 trillion, depending on who you quote. So there's a tremendous amount of need for financing in support of trade, but in particular in support of SMEs, and even more in particular SMEs based in developing and emerging markets. So out of that $1.5 trillion trade finance gap that you see on the slide, about 1.1 trillion is concentrated in Asia, and is the pain is felt by Asia-based small business suppliers. We're seeing a very clear interest in financing SMEs and financing trade by non-banks and so-called financial technology or fintech firms who are using platforms, artificial intelligence, data analytics around settlement timeframes and settlement experience to determine loan practices and loan processes with significant success, I'd say. Blockchain and distributed ledger technology and related networks, as I mentioned, the whole data piece. And more AI or artificial intelligence becoming a factor in this. Finally, we want to highlight also the reality, and I think Craig mentioned it a minute ago, about accounting treatment, regulatory reporting, and compliance. All of these are huge issues, and they will be issues for small and medium-sized businesses as much as they are for larger organizations, because compliance officials and regulatory officials don't worry necessarily about the dollar value or the euro value, whatever currency you want to focus on, of a non-compliant situation. They worry about the non-compliant situation. And they don't worry whether a large global company has been non-compliant or whether a small business on the corner of a street somewhere has been non-compliant. It's equally serious from an enforcement perspective. So those are going to be serious issues for businesses of all sizes. Craig, over to you on cash conversion.
Thank you. I know we're almost out of time, but I wanted to spend a couple of minutes on the cash conversion cycle. When I was speaking to one of my clients who works at a medium-sized entity, and I asked him, what his cash conversion cycle was, and he said he didn't bother because he thought that was only a ratio that only meant something to MNCs, and that's not correct. I think every entity needs to know what its cash conversion cycle is, track it. Is it getting better? Is it getting worse? How are you relative to your customers? I'm sorry, to your competitors, and your industry as a whole. So what it does, it measures the efficiency of your conversion of raw materials, inventory, and receivables into cash. So the formula is, and I'm not going to go into the specifics of each element here because it could depend on your country's accounting policies. But if you take your days inventory outstanding and you add your days sales outstanding, and you subtract it from the payables outstanding, that gives you that's part of the formula for determining the cash conversion cycle. So the inventory and sales produce cash, so fast is better. Payables